Hi, and good evening, everyone, and a very warm welcome to a special webinar on the RBI's October monetary policy. So, the RBI or the NPC has chosen a pause at 5.5 percentage of repo rate, with inflation at multi-year lows and growth still holding up strongly. Today, we'll dive into the governor's key messages, the insights from the monetary policy report, and what all of this means for fixed income investors, the fixed income markets, yields, and the whole backdrop of global and domestic environment. Joining us today for the discussion on the same is Ms. Kruti Chheta, fixed income analyst and fund manager, who will help us decode the implications and highlight the right opportunities in the fixed income funds. A warm welcome, Kruti.
Thank you, Tanya, and thank you everyone for joining us this evening.
Right. So for the ease of understanding of our viewers, this session will be conducted in a question and answer format, wherein I'll be asking certain questions which, might be there in all of our minds pertaining to the monetary policy, the mutual funds to look at this point in time and other things. And Kruti will very graciously be answering to that. And we'll be taking the viewers' questions towards the end of the webinar. So without further ado, let's dive right into it. So, a few topics that we'll be covering today, would be, of course, the RBI MPC decision, the global backdrop, as well as the domestic backdrop in which this decision was taken, a little on the fixed income outlook, and of course, what products to look at. So, Kruti, my first and foremost question to you is that, the RBI has paused at 5.5 percentage of repo with, a neutral stance, the continuation of stance. What does this signal to you?
So if you see this policy, it was a very thin decision between a rate cut and not a rate cut. And if we see how the members have voted also, there have been two members who have voted on the change of the stance, not the change of the policy rate. This says that everyone, the members over there, are aligned to the thought that there has been done in the previous. There are the policies that have been put in place by RBI. There are policies that have been put by government in place to focus on growth, but no one is denying the fact, given the current situation, that there is a room that has opened up for further rate cuts, which shows by the change in the stance by the two policy members as of now. The current rate decision which has been taken is primarily being taken to wait and watch the implications of the previous announcements that has happened. So we have seen that the governor has mentioned that the inflation remains benign as of now, and it has opened up space for further rate cuts. The growth, even though the previous two quarters is showing a strong momentum, the upcoming quarters might not be as strong as the previous quarters because of the external difficulties that we have. And on third, not as much as mentioned by the domestic central bank, but also Fed cutting rates has eased up the pressure for the domestic central bank also to cut further rates. So this decision of a rate cut or a not rate cut was something that market was already expecting. What they were looking out was for the comments and the forward looking guidance, which broadly has been in line with what market was expecting, a dovish tone which market was expecting. And from here on, whether the December looks most likely for a next action if you keep all the things into the perspective. But again, given all the factors that have played out so far, maybe if December or further on, there is a space which the members have mentioned that there is a space to for a further rate cut. 25-50 basis again will depend on the situation from here on.
Sure. So, diving a little deeper on the outlook side of it, on, the rationale that probably the MPC has given. So, how do you see global growth concerns from here on, especially the volatility that's present in the US Treasury yields and the probability of that spilling over into, the Indian debt or the bond markets?
What we need to look at this point of time, going a little back further on in this year, is that the decisions that MPC has taken has now become more inward looking than reacting to the external central banks. While they remain important, their decisions are looked at, but we have increasingly taken decision what suits our economy, and this has only been possible because our macro stability is much more in a better place than it used to be before. The factors that play out in domestic are much more stronger than the global, and which is why we saw that we have taken an early decision of front loading the rate cuts. 100 basis so far done, and while US was struggling with its own problem of an uptick in inflation, a possible uptick in inflation, growth slowdown, the uncertainties over the policies that have been announced over there, we continued towards a downward trend, not only in the rate cut, but also in the yield, showing that we are strong enough. Now, currently, what is happening in the domestic market is affected by global, but it is not affected because something is happening in the global market. It is affected because the announcements that are taking place are particularly related to the economy, our economy, which is why we are seeing the volatility. So therefore, we see that even after Fed rate cut that happened, our markets did not immediately react to the Fed rate cut, because there is our set of problems that are there, or the tariff announcements which are coming in, which are not getting resolved, the H1 announcement that took place. So, and because of the currency volatility, there is more fear of the FIS selling off. Therefore, we are seeing that the markets are reacting more to the domestic developments, and if domestic is stable, which is it is right now, it is reacting to the announcements on our domestic economy, which is why we are seeing this volatility. But yes, on the global front, are we reacting to what the global central banks are doing? I think we've left that far behind because the dynamics have changed uh, drastically over there.
Right. So with the changing dynamics between the advanced economies and the developed economies, even the central bank's decision making is also become very domestic in each of the economies. Right. So now on to the domestic part of it. The growth or the GDP numbers surprised at 7.8% in the first quarter of FY26. So do you think this momentum can sustain into the second half of FY26 as well? We have just entered the second half, and the RBI governor spoke much about it in depth. So, especially despite the weak external demand, due to all the tariffs and everything, both on the services and the manufacturing side, what do you think of the domestic economy and drivers for growth going forward?
So interesting point over here is that if you look at the growth projections, the growth has been revised upwards, not because there is a positive or a very positive momentum expected in the further quarters. So the growth has been revised up because of the existing quarter that has been, already reported, and the current quarter being like a festive season where we are expecting a slight uptick. But if you look at quarter three and quarter four, the growth has actually been revised downward. So therefore, we are seeing from here that in spite of all the measures that have been introduced, RBI is not forecasting a strong demand in the further quarters from here on. And therefore, the focus of the policy was also that, there are headwinds, there are external headwinds which are there, which is impacting the domestic economy, and because of that there will be other measures which will be coming on. We are seeing that they are taking constant measures on the liquidity. They are cognizant. They were
Hello. Yeah, I think we have lost Kruti in between. Give us a minute or two. We'll be back with it. So sorry for apologies for the interruption. So sorry everyone. Kruti has dropped off, I guess, in between. So till the time, there is a technical error. Till the time she comes back, I'll just take you through what she was trying to say, especially on the growth front. So, if you'll see for now, the growth drivers have been the front loading that RBI has done on the 100 basis points and the much required government capex that has been there, the external stimulus that we had been talking about, since quite a few months that the government capex is yet to revive. So that capex is the one that has been the growth driver for now. And what better to show that uncertainty is that if we'll see the GDP growth forecast numbers that the RBI had presented on a quarter-on-quarter basis, what we are able to see is only for the quarter two of 2025-26 financial year, which also comes in between with the festive season. Only there the growth demand is a little higher than the other quarters that has been forecasted by RBI. Also, if on a broader year basis, while the growth projections for the entire FY26 has been increased by little by 30 basis points, at 6.8 percentage by RBI in comparison to its, the previous policy of August, wherein it had stipulated that the growth would be increasing by 6.5. That 30 basis point increase is due to the the probability that in festive season we might see a demand push. However, if you'll see there on right in Q2, Q3, Q4 and Q1 of the next FI as well, the demand could take a hit. So, while this is on the growth side, we'll also take more questions. Allow us a few minutes. Apologies for the हाँ.
I am so
Hi,
sorry.
Kruti. No worries, no worries. Just a second. Just allow me to reshare the screen. Right. So I hope the screen is visible. And so apologies, viewers, that you had to wait. And Kruti, so I took them, around what the growth is looking like for now, and the much pent up is due to the festive season. So probably, any summary points for this growth segment that you have, and we'll continue with the next segment now.
So growth will be on outlook, but by the today's narrative, while we are going, very gaga over the GST reforms, the personal income tax which has come in, and it would help. But right now, the way RBI is looking at it is that it will negate the negativeness that we have got from the external headwinds, and this year will be more of a flattish growth rate. From next year onwards, maybe we will see the impact of it much more, and there would be much more reforms coming in, but this year we are just seeing it as a negating of the external headwinds.
Right. So, now on to the opposite part of growth, that is the inflation. Inflation is revised down to 2.6 percentage, for the full year FY 26. So, what are the risks to inflation trajectory as we, head on to the next quarter? Because the print for July was somewhere, around 1.8 percentage. However, the print for August that came in was an inch higher at 2.1 percentage. So, going forward, what's your understanding of inflation and how it could impact, on the economy as well?
So inflation has been extremely supportive this year, and we've seen that the inflation targets have been revised down. If not like every policy, every second policy, we've seen some narrative coming in and the comfort coming in on the inflation. And this time also we've seen that last policy where there was a mention of quarter 4 inflation going higher, that has also been revised down now. Inflation majorly this year has been seen a downtick because of couple of factors. One is that the rainfall has been good, and because of that good monsoon, we've seen that the sowing has been good and your vegetable inflation has come down drastically. And India's CPI basket consists 45% of food inflation. So the direct impact comes in when the food prices come down, especially your vegetables and everything that comes down. Second is that we have been extremely, let's say, fortunate in the energy prices also, because the estimates for this year for our inflation projection was $70 per barrel. It has stayed well below that and it has not gone up. Forward looking, what do we need to see on? So we are definitely talking about that the base effect might come in next year, and we might see that because of the base effect the inflation might go higher. But another way of looking at it is that if the monsoon is good next year, and even if let's say that monsoon is not good next year, the reservoir levels are high, it's at a decadal high. We've received last 2 years of good monsoon. We were supported by the last year's good monsoon also this year, and this year also it's been good monsoon. Because of that we might see that it's again anyone's guess, but the vegetable inflation and other food inflation might not see as much uptick as much as it was previously estimated. Second is that the energy prices have been range bound, and going forward also, because the global growth projection is not that positive, it remains range bound, and that plays out to our positive in the upcoming year also. And third, the possible factor is that Asian economy, if you go to see, is largely either in low inflation or a deflation mode. Now, that primarily comes because China is the largest exporter, right? And China is running into deflation. China running into deflation means that it is exporting deflation to other economies also, because it is making cheaper goods. And as a country, we also import some of the our stuff, if not completely finished goods. There are some of the parts in electronics and other parts in manufacturing that we import from China. So if China is running in deflation, there is going to be a portion of it where China is going to pass that on to the other economies also where they are importing, and India being one of them. Uh, And third thing that we need to look at is GST. If we go to see, GST has been rationalized. Most of the essentials have moved to the 5% bucket. The CPI impact or the bucket of it, we are seeing that around 18% of the bucket is getting impacted positively by CPI, which can again make a downtick in inflation of about zero point 0.6 to 1%, 1 percentage point. So all these factors cumulatively speak that inflation might not be so much of a concern going ahead also. And as governor mentioned in the speech also, that we are growing, and we are one of the fastest growing economy, but we are not at the growth that we desire. We need to accelerate more on from here, and probably a low inflation will help us accelerating even further from here on.
Right. So for inflation, probably the domestic factors look, pretty good. But of course, the tariff hit economies also would play a role, especially on the goods import and export, but from their end onto our
Mhm.
inflation as well, right? So from inflation, now my next question is that, now that we are getting, into the festive season also, and, the recent announcement of, the CRR cuts that has, released over around 2.5 lakh crore by November, it would be doing that. So how do you expect then short-term yields and money markets to, behave in this liquidity conditions? The money would be released into the system post the festive, season. So how do you see that impacting the yields, especially on the shorter end of the curve?
So, if you go to see, the previous rate cuts have been transmitted, as you can see in the chart also, into the money markets, and the yield curve also says pretty much that the impact has come in and the yield has steepened, the yield curve has steepened. But as you rightly said, RBI preempted the CRR cut and it gave it right so that it comes into the festive season and we are not liquidity deficit. Currently, we are running somewhere around the neutral levels. Now, going ahead as this festive season continues, because typically the last quarter is the festive season, we will see that the liquidity will dry up. Also, there is elections that is coming up, and we have seen in typical elections your currency in circulation increases, but your also the liquidity goes slightly into the deficit to the neutral zone. So we will see that the liquidity will not be as surplus as it was previously, but we've seen this administration being very proactive when it comes to liquidity. It means business when it wants transmission, and as and when there will be a need for liquidity, there will be a liquidity measure that would be introduced, and probably it will be introduced well in ahead rather than waiting for that moment to happen. So from here on, your money market yields will remain range bound at the levels that they are until the next possibility of the rate cut. That is when we are close to the next rate cut, we will see that some action might happen in the shorter end of the curve, but until then we will see a range bound. We can see that the longer end, if the demand comes in, then might react to the rate cut preemptively, but money markets are likely to stay range bound till the next rate cut, close to the next rate cut.
Sure. So from, the range boundedness probability of money markets, now my next question is towards the 10-year segment. So, there was a very interesting data point that had come up that, the RBI staff or the report has projected that 10 years yield could be around 6.4 percentage by the year end. So do you see this number as, backed by, while they have given enough data backing for the same, but do you also agree with this sort of a number, or do you see room for further softening? Or do you see that this long end is much more vulnerable to the global shocks? Thus, we can see much more softening of the yields than this particular number.
So the long end of the curve is becoming very, very interesting, and there are a lot of discussions that are happening over that. And governor itself was asked a lot of questions related to that. Governor mentioned that the pass through on the longer end is typically 30 basis is what they are placing at. And what he meant is that in a 100 basis rate cut, if the starting point for the, let's say, 10-year was around 665, 670, from there on, they saw that the yields went down to around 630 levels. which was more of the transmission that happened then usually of a 30 basis. From there on, we have seen that the yields have come back to the pre-rate cut cycle, and they expect that the transmission is yet to due or again to come back into the longer end of the curve. Now, whether it can happen more or less, that will depend on the two dynamics. One is that how the global is shaping up. So if we see right now, the 10-year is reacting more to the global vulnerabilities rather than the domestic situation, because domestic is fairly stable at the moment. The macros could not be better than what they are right now. Growth is in a moderation, inflation is a downtick getting revised, fiscal consolidation is in place. Even your last borrowing calendar was actually cut down in spite of so many measures given. So on the domestic front, we are very well secured. The global headwinds is something that is leading to the volatility in the 10-year GSEC as of now. And if we go by what the governor has given a definition of inflation,
Hello everyone. I think we have unfortunately lost Kruti again due to the connectivity issues. Just allow us a moment and then we'll be going on to the Q&A section only. So just allow us a minute. Yeah. Hi Kruti.
sorry, there's just some connectivity
Apologies,
issues. But
participants. Right. So you may want to continue on the last bit. We were towards the last end, that from here onwards, how do you look at the 10-year GSEC and, in this whole backdrop and wherein the RBI also mentioned that, by year end it would be seeing yields around 6.4%. So yeah.
yes, so to sum it up, the current the 6.4% that has been estimated, while it has not been given in numbers by the governor, by the market, it has been estimated at 6.4%. Purely based on what the transmission should have happened right now. But given that there is more scope for rate cut, the demand supply dynamics can change. There could be more space, but that is all dependent on how global and how the further rate cuts and demand supply dynamics take place.
Right. So, now coming on to the case, call to action part. So, for investors, for the fixed income investors which are looking at debt allocation, how should they think about the duration part? It's a two-part question I would like to ask. First, wherein do you see the duration is rightly placed, or the shorter end of the yield curve, or, towards long duration strategy? Second, which all categories, the debt mutual fund categories, would you suggest to investors at this point in time?
So, investing is always based on what the investor's target is, and when it comes to debt, there are various categories that one can look at. Now, we can divide this into two parts. One is the investor active and is looking to, change the strategies very frequently, and second is an investor who is a long-term investor and does not want to change quite often, has a investment horizon for, let's say, next 2 to 3 years. So the strategies would differ for both of them. If we look at the current base that is there and how the current environment is playing out, there is a scope for rate cut that the governor has mentioned by itself. The MPC agrees on it, but there are some external headwinds, and because of which there could be some volatility that can take place. In such a situation, if investor wants to play safe or wants to, remain in a range bound market and take advantage of spreads, can go in a category like a short duration fund or like a low duration fund or maybe like a corporate bond fund, where the strategy is not of extreme long duration, but they are in the shorter end, they're playing spreads between the GSEC and the corporate bond segment. The second is that if investor is here to stay invested for a long period of time, an investor is here to play out India's story, then they should be looking at the long duration fund. Reason being that India is structurally making a move, and as India becomes larger GDP, structurally your interest rate will also come down. We will see that this will become a new normal rather than what we have seen the rates moving from 12% to 7% to now, you know, 5.5% has become a new normal, and going ahead also as we grow in the size of GDP, that will become a new normal. So if you're looking for a long-term investment, then probably you look at the long end of the curve. But if you're looking someone who tactically wants to switch, then you right now stay invested where you're getting a good mix of duration and spreads from the capital markets.
Sure. So now let's take up the viewers' questions. So viewers or participants, if you have any questions, please type it in the Q&A box. So Kruti, there's a few couple of questions already here. So without wasting any more time, that for investors who have a long-term vision, what all categories can they look at? So the person has given an option between medium-term, credit risk category, or long-term category. Which, according to you, is how all of these categories are placed?
So the category they have given is very wide, but like I answered before, if you're a long-term investor, then you want to play safe, then you go for the longer end of the curve where there is more sovereign backing and you don't have to worry about anything. Credit risk is purely on the investor's risk appetite and the knowledge and the volatility that an investor is ready to take in the market. So there I would not comment much on the risk appetite of an investor. And third, medium term plays well tactically when you don't want to give it a thought much about switching in and switch out, and you probably want to stay invested for a medium term, let's say 6 months to 1 year, then the fund does that job for you. Another category that you can probably consider in that segment is income plus arbitrage, which does it for you, right? You don't have to keep switching between the tenures or take that call by yourself. The fund of fund that it is, it takes a call by itself in it.
Sure. So, you mentioned income plus arbitrage. Another question is on the same, that, what would you prefer between these two funds, a short-term fund or income plus arbitrage? Probably the right way would be if you could explain what are the key attributes of each of the funds, for that, the investor can then take a, very open understanding and decision as per that.
So let's take a short-term fund is something that invests in your corporate bonds, and it has limit to a duration that it can go up to. 3 years is the duration that it can go up to. And it takes an investor into consideration playing within that duration. So it can vary from, let's say, 1.5 to 3 years based on the fund manager's call that is there. But the cap is 3 year on that, right? So it is someone for a medium term investor who is looking out to like play on the spreads and on the corporate accruals. Now when we are talking about income plus arbitrage, it is more defined as a let's say dynamic bond fund where the duration does not have a cap over there, so it can invest in a fund which is as longer, like 12 years of duration, or if the interest rate call is not there, then it can go up to like as low as a 6 month product or a 1 year product. So it is very dynamic in nature, and it does not have a range where it can park to it. There is no defined range over there. Whereas in a short duration fund, there will be like a defined range in which a fund manager can invest.
Right. So there's another question that, since we have seen in the projections also that, the growth numbers are not moving, are not very positive, even by the governor's own estimate. So is there a possibility of another rate cut probably in the next MPC, or, the thereafter MPC, as per
I
you?
don't need to answer that. Governor has answered it himself over there.
Right, right. So there's another question that, which all funds are relevant for an investment horizon of 3 to 5 years?
If you are that long-term investor, then just go for a long duration fund.
Right. So there's another question that, what's your advice on the government securities at this point in time?
Government securities, like we previously discussed also, is a function currently of the external vulnerabilities that are there. And second is that there is a demand supply mismatch that has been taken place right now, because of which we are seeing that the transmission in the longer end is lower than expected. We will see that how the next borrowing calendar also comes in, and how it is getting placed, how much we are seeing that the demand can be soaked in. But overall, because this administration looks very focused on the fiscal consolidation, we don't expect the supply shock to come in. We only need to look at whether the demand will be taken care of or not. And contrary to like what the domestic investors are showing less appetite in the domestic bond markets, we are seeing that since August, actually the FII flows have been coming into the debt markets. So the foreign investors at these levels is showing much more confidence into the Indian bond markets, Indian GSEC market, than the domestic players themselves are showing. So if this continues, then we will see that the domestic will also become much more confident, and we will see like, the yields going, the transmission happening in the longer end also.
Sure. So there's another question that, some tax-free bonds that had earlier a coupon of 7.58% have crashed by, 9 to 10% in price and has a maturity of 2027. So what causes these types of crashes, and is it a buying opportunity since yields has shot up significantly? While I'll not name what bonds they are talking about, it's somewhere in the infra sector. So if you would want to add anything on the what causes probably the bond price crashes, if you would want to add something over there.
Bond price crashes in general are function of demand and supply, and how the rate, what cycle are we looking at, since there is a 27 bond that he mentioned, she mentioned, little surprising, but I guess that it is a function of a demand and supply rather than the whole market dynamic in itself.
Right. So let's take this one last question that, what parameters would you consider before choosing any of the debt mutual funds? What would you look at as an investor before choosing any of the debt mutual funds?
If you have to select a debt mutual fund for yourself, A, you have to be clear that what is your target and what is your time horizon. That clears out a lot of things, because the category in itself will tell you that where you should be going. B, you need to look at that the what is your particular view, whether you are seeing a rate cut cycle where you are seeing pause, or whether you're seeing, depending on that, in that category you can select the fund manager style that you like, or you believe in the opinion of that fund manager. And third would be, which is most important, is that the your appetite for the credit. So if you are credit adverse, then you would probably go for a high rating portfolio. But if you are a risk taker, then you can probably take a risk of a little credit in your portfolio, and the fund you can go with the fund manager who is willing to take that risk in the fund.
Sure. So, Kruti, before we summarize, anything else you would want to highlight, from the governor's speech or the, after the speech interview that you think, investors could get a little more information on what's the RBI thinking and where the Indian economy is going further.
So this policy has been one of the few policies which has come in exactly in line with how the market was expecting, with the thin line being rate cut or not rate cut. Market still expects rate cuts, and from here on, we will see a second round of opportunities coming in, since now there is more dovishness in the tone rather than the hawkishness in the tone. So it's a good time to look out for the debt markets once again.
Sure. Thank you, Kruti, for the insights, and thank you, participants, for joining us. Apologies for the glitches that we had in between due to connectivity issues. So you can read more on, what the RBI stance was, the commentary on, the global economy, Indian economy, etc. in our MPC note, which is also available on our website and other social media handles. So thank you for joining us today. Thank you, Kruti, for taking us through this. Thanks, everyone. Have a
Thank
good
you.
day.